Every single person watching this right now who owns gold is asking the same question. Gold is sitting at $4,428 per ounce, down 21% from its all-time high of $5,596 reached on January 29th. And you are watching central banks unload reserves. You are watching the lira collapse. You are watching Turkey liquidate 60 tons in 2 weeks. And somewhere in the back of your mind, you are asking yourself, is it over? Is the bull market finished? Did I miss it? Stop the madness. You are asking the wrong question entirely. The question is not whether the bull market is over. The question is whether you understand what a reset actually is. Because what is happening right now in this gold market is not a collapse. It is not a breakdown. It is not a regime change. It is a forced liquidation sequence that I have watched play out 4 times in 40 years of managing capital. And every single time it played out, the investors who understood the mechanics made fortunes. The investors who read the falling price as confirmation that the thesis was broken got wiped out. I am going to show you exactly which one you are going to be. But first, you have to understand why gold is falling. Not the surface explanation everyone is giving you on television, the actual mechanism. Because until you understand the mechanism, you cannot understand why I am using the word reset and why I believe the reset that is happening right now is the biggest one yet. Listen to me. When Iran closed the Strait of Hormuz on March 4th and Brent crude went from $75 to over $100 per barrel in 3 weeks, something happened that almost nobody in financial media explained clearly to regular investors. Oil is priced in dollars. Every barrel of oil that every energy importing nation on earth needs to buy has to be paid for in dollars, not euros, not lira, not rupees, dollars. So when oil spikes 40% in 3 weeks, the demand for dollars spikes with it. The dollar gets stronger, and when the dollar gets stronger, the price of gold, which is denominated in dollars, gets suppressed mechanically. Not because gold is broken, because dollars are more expensive. That is step 1 of the mechanism. Now here is step 2. Higher oil prices drive inflation expectations, and inflation expectations prevent the Federal Reserve from cutting rates. The Fed had been signaling the possibility of cuts. The oil shock ended that conversation permanently. Fed funds futures now show virtually zero probability of a cut before late 2026 at the earliest. When the Fed cannot cut rates, the 10-year Treasury yield stays elevated. It is currently sitting at 4.39%. Think about what that means. A risk-free U.S. government bond is paying you 4.39% annually. No volatility, no storage costs, no counterparty risk, guaranteed. When that number is at 4.39%, the opportunity cost of holding gold, which pays you nothing, rises dramatically. Institutional capital does the math. Some of it rotates out of gold and into treasuries. The price falls further. 3 headwinds operating simultaneously, all 3 caused by the same oil shock that, by every conventional understanding, should have been screaming bullish for gold. That is why your gold position is red while bombs are falling. It is just math, folks. Now, let me tell you about the dumb money trap, because this is where the carnage actually happens. When Iran closed the strait and gold spiked to $5,419 on March 2nd, what did retail investors do? They watched CNBC, they saw the graphics, they heard the anchors screaming about geopolitical risk and safe haven demand and $6,000 gold, and they bought. They bought gold at $5,400, they bought silver at $95, they bought at the absolute peak of the emotional spike. And then something happened that none of those television anchors warned them about. The mechanical sequence I just described kicked in. Dollar up, yields up, gold down. The price fell to $4,428. That is a 21% decline. And those retail investors, the ones who bought the fear spike, are now sitting on losses. Tears don't make you money. And what did those same retail investors do when they saw their gold portfolios down 21%? They watched more CNBC. They read the headline saying gold has failed as a safe haven. They concluded the thesis was broken. And they sold. They locked in their losses at the exact bottom of the forced liquidation cycle. And they will spend the next 18 months watching gold make new all-time highs from the sidelines, telling themselves they will wait for the pullback that never comes. I have watched this happen after every single major crisis in my career, every single time. It is not bad luck. It is not bad timing. It is emotional decision-making dressed up as rational analysis. The financial media sells fear because fear drives clicks and eyeballs and advertising dollars. Your losses are their business model. Be pragmatic. Here is the secret mechanism that Wall Street saw coming and almost nobody explained to you. Turkey imports approximately 90% of its oil and 98% of its natural gas. When Brent crude went from $75 to over $100 per barrel, Turkey's annual energy import bill increased by approximately $20 billion. Not gradually, immediately, because energy contracts are priced in dollars, and Turkey needs dollars to pay them. The Turkish lira hit a fresh record low against the dollar at least 11 times since February 28th, 11 times in 16 trading days. Turkey's inflation was already running at 37%. The central bank is staring down political collapse if the currency free falls further. So Turkey faced three options: let the lira collapse, burn through dollar reserves, which were already dangerously low, or sell gold, take the dollars from that sale, use those dollars to defend the currency peg. Turkey chose option 3, 60 tons in 2 weeks, $8 billion. That is not a strategic portfolio adjustment. That is a sovereign nation being margin called by a war it did not start. JP Morgan estimated that precious metals worth approximately $30 billion out of Turkey's total $135 billion in assets held at the Bank of England could be used for further operations. That number has a ceiling. Turkey does not have infinite gold to sell, but Turkey is not the only one. Russia's central bank began selling gold in 2025 to finance war expenditures, raising approximately $2.4 billion through February 2026 and reducing its holdings to a 4-year low. Poland's central bank, the most aggressive gold buyer in the world over the past 3 years, has proposed monetizing approximately 550 tons of its reserves for defense spending. That is $13 billion. The governor outlined the proposal in early March. China's People's Bank paused gold purchases in the fourth quarter of 2025. India's central bank became a net seller in January 2026 as the rupee came under pressure. Think about what that list represents. Turkey selling, Russia selling, Poland considering selling, China paused, India selling. These were the most active buyers of the entire gold bull market. The institutions that drove gold from $1,800 to $5,596. Together, they represent a simultaneous shift across multiple official sector participants from net buyers to net sellers or sellers in waiting. That is the force that is driving this reset, not a change in the structural thesis, not a breakdown in the long-term case for gold. Forced liquidation, central banks selling not because they decided gold was no longer a strategic reserve asset, but because a war they did not start created a dollar demand crisis that left them no other option. 1 + 1 = 2. Now let me prove to you why this is a reset and not an ending. I have watched 4 major resets in the gold market in 40 years of managing capital: 1976, 1983, 2008, 2013, and every single one of them followed the exact same pattern. Forced selling hits the market, not strategic selling, forced selling. Central banks that spent years accumulating are suddenly compelled to liquidate because a crisis has destroyed their dollar inflows and they need cash to survive. The gold price falls significantly. Retail investors, seeing the price fall, conclude the bull market is over. They sell. That adds to the selling pressure. The price falls further, and then, when the forced selling exhausts itself, when the crisis that triggered it stabilizes, when the dollar demand that the oil shock created normalizes, the structural buyers return. I lived through the dot-com bust. I traded through 2008. I have seen this exact movie before, and I know exactly how it ends. Go back to 1973. The OPEC embargo hit in October. Oil went from $3 to $12, a 4-fold increase. Gold initially dropped. Then gold rose 150% over the following 2 years. Then, during the Iranian Revolution from 1979 to 1980, crude oil surged over 110%. Gold climbed nearly 150%. By 1980, gold had risen 2,300% from its 1971 price. Not from the moment of the shock. From the moment the shock proved to be structural, embedded in the monetary system, impossible for central banks to fight without destroying the economy. Post-September 11th, gold began a decade-long bull run from $250 per ounce all the way to $1,900. That is a 660% move over 10 years. Russia invades Ukraine in 2022. Gold breaks through $2,000 for the first time. New all-time highs. Every major oil shock in the last 50 years. Same pattern, forced selling, emotional retail capitulation, structural recovery, new highs every single time. The central banks that were forced to sell during those crises did not abandon gold as a reserve asset. They sold because they had no choice, not because they changed their strategic view. And when they could buy again, they bought. Turkey still knows that gold cannot be frozen, cannot be sanctioned, cannot be printed away. Turkey sold gold because it needed dollars in a crisis. When the crisis passes, Turkey will buy gold again because the strategic logic that drove its accumulation over the previous decade has not changed. Now, let me build the structural case that makes 2026 categorically different from every previous cycle. Because this is the part that should make you sit down and pay attention. Fact 1. In 1973, when gold began its historic bull run, the United States national debt was approximately $500 billion. Today, it is $39 trillion. That is not a larger version of the same thing. That is a categorically different fiscal reality. The Federal Reserve is paying $1.03 trillion annually in interest on that debt. It cannot raise rates to 20% the way Paul Volcker did in the 1980s to crush inflation. The arithmetic does not permit it, which means the oil shock from the Iran war is embedding into an inflationary environment that cannot be addressed through the same mechanism that resolved the 1970s version. The suppression mechanism, the one keeping gold at $4,428 right now, is running on borrowed time. Fact 2. In 1973, central banks were selling gold. Today, central banks are forecast to purchase approximately 850 tons of gold in 2026, still historically elevated, far above the pre-2022 average of 400 to 500 tons. 3 consecutive years of purchases above 1,000 tons, followed by continued elevated buying. That is not portfolio diversification. That is strategic repositioning. And here's the reason why that repositioning will continue. When the United States and its allies froze Russia's currency reserves in 2022, policymakers across the developing world took note. If your reserves can be frozen with a keystroke, they are not really yours. Gold is different. No counterparty risk, cannot be printed, devalued, or sanctioned. That realization did not change when Turkey was forced to sell 60 tons to defend its currency. The strategic logic is intact. The selling is crisis-driven, not policy-driven. Fact 3. In 1973, there was no silver supply deficit. There was no AI infrastructure driving industrial metals demand. There was no de-dollarization movement of the scale we are witnessing now. Today, the silver market is in its 5th consecutive year of structural supply deficit. Industrial consumption continues to outpace mine supply, and most silver production is a byproduct of copper, lead, and zinc mining. You cannot simply decide to produce more silver in response to a price signal, and the industrial demand base is unlike anything that existed in any previous cycle. Every solar panel, every electric vehicle, which requires 60 to 80 grams of silver per vehicle compared to 15 to 20 grams in a conventional car. Every AI data center cooling system, every defense electronic, every semiconductor. And China, which controls approximately 60% of global silver refining capacity, has restricted silver exports as a strategic material. 5 consecutive years of deficit. No supply response coming. Industrial demand growing in applications where silver has no viable substitute. That is not a commodity story. That is a structural imbalance that mathematics says resolves at dramatically higher prices. The arithmetic does not permit anything else. Now, let me give you the Mr. Wonderful playbook, because understanding which phase we are in right now changes everything about what you should do. Phase 1 is the forced liquidation phase. This is where we are right now. Gold at $4,428, down 21% from its all-time high. The sellers are not making strategic decisions. They are meeting obligations. Turkey is defending its currency. Russia is funding a war. The selling pressure is real, it is large, and it is by definition finite. Countries cannot sell more gold than they own. Turkey's combined drawdown of approximately 58.4 tons across 2 weekly reporting periods has a ceiling. J.P. Morgan estimated $30 billion in precious metals could be used for further operations. That is a number with a floor under it. Additionally, Russia is banning gold exports from April 2026, making it illegal to export gold bars above 100 grams. Every Russian gold holder who wants to move assets freely has a window of days to sell into the international market before that window closes. When it closes, a significant source of current selling pressure is removed permanently, and a significant gold-producing nation is simultaneously locked out of the international market, tightening future supply. The forced selling exhausts itself. It always does. Phase 2 is the stabilization phase. This begins when oil stabilizes, when Saudi pipeline capacity and alternative supply routes absorb enough of the Hormuz disruption that emergency dollar demand from energy importing nations begins to moderate. There are already signals that Iran negotiations are underway. When Brent crude falls toward $85 to $90 per barrel, the marginal dollar demand that is forcing Turkey's hand diminishes. The lira stabilizes, the forced selling slows. Watch the US dollar to Turkish lira exchange rate. When it stops making new record highs, watch gold. Watch Brent crude. Watch tanker traffic data through the strait. Those two data points will tell you when phase 2 has arrived. Not the gold price, not the headlines, the yield and the crude. Phase 3 is the structural re-entry. This is when the central banks that sold during the crisis begin to rebuild. Not immediately. Within the 12 to 18-month window that historical resets have typically taken to complete. China has not signaled any reduction in its accumulation program. The People's Bank of China extended its gold purchases for 15 consecutive months through January. India's structural incentive to hold gold has not changed. The strategic buyers have not left. They have paused or been forced to sell temporarily. When they return to a market where the forced selling has already occurred, where the price has already reset, where the accumulation opportunity is larger than it was at the previous highs. JP Morgan has raised its gold price target to $6,300 per ounce by end of 2026, with an $8,000 upside scenario on the table. Wells Fargo Investment Institute has set its year-end target at $6,100 to $6,300. UBS has its target at $6,200 by September 2026. Those targets were set before Turkey's $8 billion sell-down. They have not been withdrawn. The institutional research departments that set them are not watching gold fall from $5,596 to $4,428 and concluding the structural case has changed. They are watching forced liquidation create the buying opportunity that comes before the biggest reset yet. Dead to me are the people who see an institutional bank publishing a $6,300 target and conclude that a 21% temporary pullback invalidates it. So here is what you watch. Two metrics. Everything else is noise. The first is the Turkish lira against the dollar. The lira has hit a fresh record low at least 11 times since February 28th. That is the single most reliable indicator of when one of the two largest confirmed sources of selling pressure in this market will have turned. When the lira stops making new record lows, the urgency that is driving Turkey's central bank to liquidate gold reserves begins to diminish. You will know phase 2 has arrived when that exchange rate stabilizes. The second metric is Brent crude. Every week oil stays above $100 is another week of elevated dollar demand from energy importing nations, another week that forces Turkey's hand, another week that suppresses gold through the mechanical sequence I described. When Brent crude falls toward $85 to $90 per barrel, the fundamental driver of this entire forced selling sequence begins to moderate. The inflation expectations that are keeping the Fed from cutting rates begin to ease. Bond yields, currently at 4.39% on the 10-year, begin their decline. The opportunity cost argument against holding gold weakens. Institutional rotation back into gold becomes mechanically favorable. All three headwinds begin reversing simultaneously. Watch the lira. Watch the crude. Everything else is just noise. The war coverage will not tell you when to act. The daily headlines will not tell you. The CNBC graphics will definitely not tell you. Be disciplined, or the market will eat you alive. I have been through enough of these cycles to tell you this with confidence. The forced selling does not change the destination. It changes the price at which you can get there. In 1973, the investors who bought through the pullback and held through the volatility turned $10,000 into $243,000 over 9 years. The investors who bought the spike and sold the pullback missed the 2,300% move entirely. They were right about the direction. They were wrong about the time frame. And that mistake cost them everything. Two types of investors are watching this unfold right now. The first type sees gold at $4,428, down from $5,596, and concludes the trade is over. They sold at the bottom of phase one. And 12 months from now, when gold is making new all-time highs, they will say they knew they should have held. Tears will not add value to that portfolio. The second type sees the same price and thinks forced liquidation, finite ceiling, structural setup more powerful than at any previous point in history. And they accumulate quietly while the noise is at its absolute loudest. I am a disciplined investor. I look at the $39 trillion national debt. I look at the $1.03 trillion in annual interest payments that make aggressive rate hikes mathematically impossible. I look at the 850 tons of central bank gold purchases forecast for this year. I look at 5 consecutive years of silver supply deficits with no supply response coming. I look at 60 tons of Turkish gold with a hard ceiling and a Russian export ban approaching in days. I look at JP Morgan's $6,300 target and an $8,000 upside scenario still on the table. And I see a reset, the biggest reset yet in a bull market that is not over. It is catching its breath. Watch the lira, watch the crude. The floor is being built right now, somewhere between $4,000 and $4,500, based on everything I'm reading in the data. That floor is the launching pad, and the launching pad, when the forced selling exhausts itself and the structural buyers return, is the setup for the largest move yet in this cycle. Be patient, be disciplined, and do not let a phase of forced liquidation that you now completely understand make you miss the biggest trade of the next 5 years.